suspect there's two reasons for that. The first is you rightly compare real with nominal interest rates. And I think people around the world are beginning to understand that the pace of the underlying deterioration of the US dollar is greater than that which is explained away in official sectors. Most people's perception of inflation is based on the CPI, which Mike Maloney famously calls the CP lie. If you believe in the CPI stated rate of inflation, you believe that the purchasing power of your currency is declining at 2.6 or 2.7% per annum, compounded. But that's fallacious, and people are coming to see that expressed in the way they live. Gasoline prices, food prices, health insurance. I think a more accurate view of the deterioration of the purchasing power of the US dollar is closer to 8 or 10%. Viewed through that lens, making 5.5% on a US 10-year Treasury isn't making 5.5. It's losing 3.5 or 4.5. And people around the world are coming to understand that. The second thing is that people around the world are coming to trust the United States as an entity and as a creditor, as a debtor, less. Whether or not you agree with Russia's action in the Ukraine, the fact that the United States stole $300 billion worth of Russian assets in the form of U.S. treasuries sent a message, a warning shot across the bow of every nation on earth that might run afoul of the U.S., which is, of course, every nation on earth. And so we have forced foreign central banks out of their asset of choice, which was U.S. treasuries, which earn a yield, into their second choice asset, which is to say gold, which has no yield, but also has no counterparty risk. So I think those are the two reasons. Put very bluntly, continuing and deteriorating lack of trust in U.S. society as a debtor, and the continuing and increasing unattractiveness of the U.S. dollar as a store of value as a consequence of the continued and underappreciated deterioration in the purchasing power of that U.S. dollar. I think, and understand, I wouldn't describe myself as an intelligent Fed watcher, but I think the increasing gap in real yields between the short-term rate and the long-term rate suggests that the rising long-term rate has a lot to do with the Fed losing its grip on long-term rates. The market is reassessing its grip.
Back in 2022, Western governments froze roughly $300 billion in Russian central bank reserves, a mostly euro and dollar-denominated stockpile, much of it still sitting untouched at Belgium's Euroclear. Years later, while European officials continue debating whether to seize it outright, the message already reached every finance ministry on Earth. Even sovereign reserves held abroad can be frozen overnight if politics shift. Since then, central banks have measurably changed their allocation strategy, buying gold at more than double their pre-2022 pace, over 1,000 tons annually. Unlike a treasury bond, bullion sitting in a nation's own vault answers to no foreign government.
So the increase in long-term rates, I think, is increasing for precisely the same reason that the gold quote has. The long bond was overbought and became sold as a consequence of the deterioration of the purchasing power of the U.S. dollar. Investors want more compensation for tying their wealth up in a depreciating asset class. I think the reason that the long bond yield and the reason that the gold price belatedly has begun to increase again are the same. And people view gold separately. People who began to be interested in gold 2 years ago or 3 years ago don't believe that gold is up from 44 to 45. They believe it's down from 55 to 45. It really depends on the perspective that you have, the length of time that you've held the gold, and why you hold it. I'm in a third class. I've been saving in gold personally since the year 2000. And for me, gold has really, 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 truly done its job. When people talk to me about the fact that the gold price is down, I say, down from 260 to 400 to 4,500. Doesn't feel like down to me, but keep it going. So I think the answer to your question really depends on your perspective. I'm less confident talking about the stock market. I don't view the market myself as a subject. I view it as a facility, a place where one buys and sells fractional ownership of businesses. And my reticence is that outside of conventional financial services and natural resources, I don't know how to value those businesses. I can tell you the price of NVIDIA, but I can barely pronounce it. And I have no idea what it's worth. So when people tell me that the U.S. stock market is systematically overvalued, I don't know how to validate or invalidate that statement because I don't know how to value the tech sector or the consumer staple sector, or the consumer durable sector. I only know how to value the financial services sector and the natural resource sector. In the sectors of the market that I follow, the market is not overvalued. Those businesses, at least in financial services, the small cap and mid cap names, are not overpriced relative to their ability to generate cash. So I understand your question perfectly, and I think it's one that people should ask themselves. Unfortunately, outside of my two little investment ghettos, I don't know how to answer it.
There's a growing view that long-term interest rates are climbing not simply because of Fed policy, but because the market itself is reasserting control, demanding more compensation to hold an asset class whose purchasing power keeps eroding. That's the same dynamic some analysts think is quietly lifting gold. Both are repricing to reflect a currency depreciating faster than official statistics admit. History offers a precedent. In 1975, when the Fed briefly let rates rise to fight inflation, stocks, autos, and housing all cratered together until falling living standards became politically unbearable and rates were forced back down. Gold then rallied from $100 to $850 an ounce over the following 5 years.
I don't know. I save in gold. I also maintain liquidity in currencies, but I save in gold. So for me, gold and silver are very different asset classes. Silver is a speculative asset class. And silver, relative to other classes of speculation, remain unattractive to me. Silver is not hated. I own silver because it was hated. There's some recent buyers who are disgusted with it, but they don't hate it. They're still in the hope phase. And I only buy speculations in the despair or hate phase. And we aren't close to there in silver yet. I buy gold not to make money, but to avoid losing purchasing power. And I'm a systematic saver, almost irrespective of price. To me, it's liquidity, insurance, and wealth, all rolled into one. Going back to your initial question, the Fed, I think you need to look at the political realities of America. I think that the Fed chair, and I should say, by the way, I'm in the banking business, so I deal with lower-level members of the Fed all the time. And I think the bias within the population of the Fed itself is that interest rates are artificially low. That if interest rates were set by the market rather than by the Fed, they would be 300 or 400 basis points higher than they are today. And I think there's a bias in the Fed to allow the market to begin to reassert control over interest rates. We saw that happen. Old people like me saw that happen in the middle of the decade of the 70s in 1975. In 1975, there was a temporary bias on behalf of the American voters that inflation was a problem and had to be solved. And interest rates were allowed to rise in 1975. And that cratered the gold price, cut it in half. But it didn't just crater the gold price, it cratered the Dow. It cratered the long bond market. It cratered the auto market. It cratered the housing market. And the U.S. voter and hence U.S. Congress lost their nerve. By the end of 1975, forced the interest rate down. That told savers in the United States and around the world that American politics were more important to Americans than the sanctity of the U.S. dollar. And when they forced the interest rate down at the end of 1975, gold went on a real tear, went from $100 an ounce to $850 an ounce in 5 short years. And I think in that regard, past is likely prologue. If the bias of the Fed employees, let me rephrase that, if the American voters allow the Fed to allow the market to set long interest rates will be higher. Gold denominated in US dollars will go lower, both because the numerator increases, but also because the cost of owning gold goes up. But gold won't be the only thing that's hit. The 30-year mortgage will be hit, which means that residential real estate will be hit. Auto sales, because autos are financed, will be hit. The stock market will be hit by the income differentials between the long bond and the Dow dividend rate. And if past is prologue, Americans will not allow their near-term living standards to be compromised by the desire for the integrity of the dollar. And the consequence of that is that the political class will force down interest rates. And if that happens, I suspect gold will explode for much longer than many people believe. Yeah. My friend Doug Casey says the US dollar is the worst currency in the world with the sole exception of all the rest of them. And I believe that to be the case.
Yeah, that he does.
He also says that the dollar's an I owe you nothing, while the euro is a who owes you nothing, given that there's 17 or 18 countries allegedly backing the euro. And I think those are good points. The U.S. Treasury market, for all its faults, is the deepest and most liquid and most transparent market in the world. There's no market that is anywhere near as liquid or anywhere near as transparent, which is really, really, really important. It's taken a lot of skill to ruin the U.S. dollar franchise. When people talk about how stupid government officials are, I point to them being able to wreck the best franchise in human history. They're very skilled in a very negative sense. And I think the debasement continues, and I think the U.S. dollar supremacy continues too. I think that the U.S. dollar will lose its market share as a store of value and a medium of exchange. But I believe, I'm 73 years of age and very healthy, I believe that for the balance of my lifetime, that the U.S. dollar will still be the world's reserve currency. I just believe its market share will fall. The fact that it remains the world's reserve currency, does not mean that it should constitute the cornerstone of my savings. I personally will continue to save in gold. I think it's also important that your listeners need to understand the context of your description of real yields. Because I don't believe, to me, a real yield is a positive yield in excess of the rate of deterioration of the dollar. When you suggest that real yields are outpacing nominal yields, you're correct. But in a historic sense, a real yield is a yield in excess of the rate of deterioration of the US dollar. I would argue that if your listeners constructed, not like the CPI, but a basket of goods and services that their families really acquire, and they compare the price levels that existed in 2020 with the price levels that exist in 2026, that they would determine that their savings and their salaries, the value, the purchasing power of their currency is declining at 8 or 10% compounded, not 2.5 or 2.6. Now, there's an interesting paradigm there. If the market actually did set interest rates, if, as an example, the yield on the primary savings asset in the world, the U.S. Treasury, was positive, if you assume, just for arithmetic's sake, that the rate of deterioration of the U.S. dollar is at 10% compounded, in order to have a traditional real yield, you would need the U.S. 10-year Treasury to be yielding something like 11.2 or 11.5. If that happened, the 30-year mortgage would likely be at 12.5. And that would have real impacts in the near term on the U.S. economy.
In a pitchforks and torches kind of way.
Yeah, so it's the way I solve the paradox for myself is to understand that it's very likely that most Americans don't care about real yields, that most Americans are absolutely delighted to maintain their current living standards at the expense of their children and grandchildren, which is what debasing the currency is all about. It's also, by the way, what entitlement's about, what government spending is about. It's really about people today stealing from their children and grandchildren, something that people are delighted to do. And likely that continues. My job then, for myself and for the people I talk to, is to defend themselves from their own capriciousness, to save in a medium of exchange that's simultaneously a store of value, so that the theft that they practice against their children and grandchildren is less egregious, because they'll hopefully be able to leave them gold or other assets that maintain their real purchasing power. Sorry, I just wanted to get into the discussion of real interest rates, because when people from the credit community, folks, green eyeshade folks like me, credit analysts, talk about real yields, they're talking about yields in excess of the real rate of inflation. And that's very different than the way credit markets today talk about yields.
Not everyone holding gold is chasing a price target. Some describe it simply as liquidity insurance and long-term savings rolled into one, bought systematically regardless of the daily quote, specifically to preserve purchasing power rather than chase a return. Measured in gold rather than dollars, everyday goods, housing, energy, food look remarkably cheap over multi-decade stretches, reinforcing the view that rising sticker prices reflect currency weakness more than genuine scarcity. Silver sits in a different mental category entirely for many long-term holders, a speculative position bought during periods of neglect, though not yet the kind of despair phase pricing that historically marks a true bottom.
Note that core inflation doesn't include food or fuel. If my camera had a full body shot, you would learn that any measure of inflation that didn't include lunch was of no interest to me. You will note, too, that CPI doesn't include tax. Now, Ilya, I assure you that if I didn't have to pay the tax, I wouldn't bitch about the index. But the truth is I eat, I drive, and I pay tax. And I think that the CPI is a completely artificial construct. And I think that one of the greatest errors that American savers make is thinking that the CPI is anything other than an instrument of deception. As you can tell, I feel fairly strongly about this. Anecdotally, I began saving in gold systematically in 2000, and I maintain an informal ledger of my purchasing power and the prices of things in gold. If you do that, you are struck by how cheap stuff is. You're struck by how cheap housing is. You're struck by how cheap energy is. You're struck by how cheap food is. If you conduct this thought exercise, tracking the price levels in dollars relative to the price levels of gold, what you will learn is that the price level of things, which has become a political issue, is illusory. It isn't that food prices have gone up, it's that the purchasing power of the US dollar has gone down. And it's a truism, too, that wages for people who don't have the correct type of education to apply capital have been stuck, while skills-based wages have increased. But it's important to note that what is regarded by many as a structural flaw in the economy is really a measure of the deterioration of the purchasing power of the dollar, the real deterioration of the purchasing power of the dollar, relative to the ascribed rate of inflation measured by the CPI.